With that backdrop, let's invite our market master for the morning. Mihir Vora, the Chief Investment Officer at Trust Mutual Fund, is with us in our studio. Mihir, good morning, and thank you very much for cheering up our 31st by coming to the studio. We aren't the only two people working.
Yeah, absolutely. Always a pleasure to be here.
Yeah. Okay, well, for starters, I mean, we've lost enough from the 26,300 plus mark. Does the market look attractive at any level, or do you think you'll wait for dips to buy?
So let's keep today the glass half full day. Okay. The markets are still up 8 to 9%, right, on the Nifty. The small cap index is still up 25%, the mid cap index also. And it's been a wonderful year in terms of stock picking. You know, if you look at the sectoral dispersion, on one hand, in a good market, in a bull market, you have the high beta sector, which is real estate, which did so well, 38% up on the real estate index. But in the same year, you also have the pharma index, which is up 35%. Yes. So defensive is also up. A high beta sector is also up. So it's been a wonderful year for stock picking. And while the Nifty, which is the large cap index, is up 8 to 9%, you have the broader market, which has done really well. So I think if you just step back a bit and see the returns of the Nifty this year, they're kind of normalizing the returns of the previous year. The previous year we had 17-18% returns on the Nifty. So now this year we had single-digit returns, so kind of averaging out. So we are starting off with a good normalized base, I would say. We're not stretched in terms of overall valuations. Expectations are not that high at the Nifty level. Probably yes, in some small cap, micro caps, there is a bit of a stretch. But in general, we are starting off with a good base. I think a boring year would be good.
You know, I just want to put, what Mihir had tweeted a couple of days back, that 2024 is the 9th year of positive yearly returns. And this is the longest run of back-to-back positive years of returns since the inception of sensex 45 years ago in 1979. That said, the current streak is the longest in number of years, which is basically 9 years, but the lowest in terms of percentage returns. Yes. Because in 9 years, we've only gone up 3x, while in the previous long stretches of returns, we've seen gains of 6, 7, 8% as well.
8x, yeah.
So what does it tell you, right? What happens after the markets run up 9 years? Do they correct over the next 3 years, 4 years? I mean, how should you view this data when you have a longer lens?
Sure. So I think it all boils down to valuations. Probably the markets have also evolved a bit. So maybe they are less volatile than before. Lot more institutional participation, lot more retail participation now. So to that extent, the markets have evolved. And frankly, the reason why probably we had this long stretch of positive returns, though may not be the best in terms of absolute returns, is also the fact that globally, after 2008-9, central banks have kind of backstopped the markets at every downturn, So to that extent, maybe it may be artificially propped up because of central bank actions, but that's the way it is.
Okay, let's speak about the mid-caps, because that's what all of us are chasing, and that's where all the gains are. Do you think there the rally can continue, especially in really attractive businesses, not stock valuations, businesses, e-commerce, EMS?
Absolutely. And I'd kind of make a distinction between mid-caps and small caps because, the way it is, we have kind of artificially, defined the top 100 as large cap, the next 150 as mid cap. So technically, mid caps is only 150 stocks. But let's say I'm talking about the broader market, which is all the mid caps and small caps. I think that's where the real action is because as the economy evolves, and we are evolving in terms of demographics, income levels, you'll see more and more segments like premium consumption, financialization savings, capex, infra, real estate, all those segments which are frankly not represented in a meaningful way in the top 50 companies. So the real stock picking chances are there. Government linked sectors like PLI linked schemes, those are the ones which are really doing well. And you can see it, the EMS theme that you mentioned.
Aren't there not pockets but large areas, swathes of overvaluation?
Overvaluation, it's
EMS and e-commerce.
So that's the whole thing, and which is where our philosophy of terminal value investing comes into play. When a sector or a stock is starting from scratch, and if you see a 10, 20-year runway of growth for the segment itself, for the sector itself, then the top stocks in the sector will trade at a premium, will trade at a meaningful premium, because when you're starting at zero, the base can grow at 25-30% CAGR for 10, 20 years, which we have seen. For example, when the first private sector banks came in, They grew at
When the first
25%.
Infosys came.
They grew at 25-30% CAGR for 15, 20,
So
30
which are
years.
these sectors? EMS is one, defense is one.
EMS, defense. I think the whole of capex still has 5 to 7 years more to go minimum. Because
Capex as well.
Because right now everything in the capex world has been propped up by government spending. We really haven't seen the private sector kick come in. Once that comes in, and who's going to make the factories for EMS or defense and all? It has to be based by capex, right? And again, stepping back, we say we want to compete with China, right? But China, Japan, Korea, at their peak and maintaining that peak for 10, 20 years, they were investing 40 to 50% of their GDP in fixed assets, in capacity, infra creation. We are currently at 30%, 32%. And China is 5 times bigger than us. So even today, China is investing $7 trillion in infra and physical assets every year compared to our $1 trillion. So we have a long way to catch up. And if China plus one becomes a reality even to the extent of 10%, we'll need to double our industrial base.
So the structural opportunities are capex, manufacturing, etc. But just for, say, 2025, those who like to play for 1 or 2 years, where are the opportunities, according to you?
So structural opportunities always remain the core of our portfolio. But tactically, I would say that financials, especially the banks and NBFCs, have underperformed.
In NBFCs, where?
In NBFCs, I would stick to the mortgages, the second-hand vehicles financing, the bigger ones. I would not really go down the curve in NBFCs even now. So the bigger NBFCs across segments look good, not so much on the unsecured loan part because RBI is still keeping a close watch on the unsecured part. But the secured lenders, whether it's on the auto finance, truck finance, mortgages, etc., I would go for gold finance, I would go for on the NBFC side. But private sector banks are really attractive now in terms of valuations. And the reason why the banking sector underperformed is because credit growth came down. Now it's almost down to 10%. I don't think we can go lower than that in terms of credit growth. It can only go up.
And Reserve Bank is now on a
and valuations are attractive. Exactly.
Any others?
And that's almost 35% of the Nifty. So there's a big chunk of the Nifty which is looking up.
Large NBFCs, large private sector banks.
Absolutely. The second pocket I would say is certain chemical stocks which have underperformed for almost 2 years now because of China coming back and all. So that pocket looks good. Even
we have Vinati Organics joining us, so maybe you want to listen.
Yeah, and auto also looks good. Again, auto having underperformed. I don't think a country like India can have suboptimal auto growth for too long a period. So last few months have been a bit suboptimal. That has to normalize.
Okay. Well, what's your sense about the underperformance in Reliance? Some of the big why did Nifty not do as well as the mid caps? It's because many of these big boys did not perform. Other than banks, there are big stocks. Do you think that now they are at good valuations?
See, I'm personally not a big value investing fan. So we don't buy stocks just because they are cheap. And our view is that the global economy will not do as well as the domestic economy. So India, I would rather stick to stocks which are more domestic facing because I think the domestic GDP growth will be structurally higher even for 2025 as well as structurally for the next 10 years will be higher than the rest of the world. So global cyclicals we are not very positive on, especially because of the fact that China, which is the largest consumer and producer of all these commodities and metals and all, is not growing as fast as it used to be. I think China has created all the infrastructure that it needed to, and more probably in terms of real estate also. So global commodities, I don't think we would be structurally bullish on. And that's the reason, why some of these stocks in the energy space, in the metal space are not performing. And that I think will continue to be a theme going forward too.
Okay.
And that's why the question mark on Nifty performance versus the broader market.
Doesn't consumption worry you? I mean, we've heard so much in Q2 about FMCG and then Godrej Wonders and then you saw the Q2 GDP numbers, consumption, and even how much more can even discretionary consumption go? Titan has not had a great year. So I'm just asking the entire consumption thing.
So discretionary, I don't think is a problem yet, in especially high-end consumption.
Hotels.
Hotels, airlines, jewelry actually not doing too badly. The structural dynamics of the industry is changing, but per se the segment is not growing at a suboptimal level. But everything, for example, liquor. Liquor consumption,
oh, yes.
the spirits companies are doing well.
It's been everyone's buy.
Yeah, so hotels, liquor, airlines, premium cars, premium real estate.
SUVs.
Premium real estate is rocking, right? So premium consumption is not a problem. So basically the discretionary theme. In FMCG, I'd say that things will normalize both in terms of margins as well as in terms of volumes, because the governments are spending now. All these state government schemes for the women, etc. They're actually some kind of an indirect UBI, universal basic income, coming in. So that should kick the consumption theme also.
What's very quickly and briefly, tell us what's the big global call that you're taking? Because we do get impacted by what happens, on the global front.
Sure. So the base case, and we'll talk about the risks to that base case. Base case is that it will be a normal year.
Okay.
So CY 2024, the global GDP growth was around 3%, expecting similar numbers for the next. US economy, which did very well, almost 2.5%, 3% last year, probably will slow down to 1.5 to 2%, which is fine. Corporate earnings are still doing well there. And for India, about 6.5% GDP growth. So that's the base case we are working with. So as I said, a boring normal year will be a good outcome next year.
Okay. And what are the sectors that you would completely avoid, at least as per the visibility that you have right now?
Avoid, I wouldn't say it may be a strong word, but as I said, global cyclical still not very positive on.
So that's
I
metals.
still believe in the domestic story.
Okay. What about IT and pharma? And will rupee depreciation be a big tailwind?
So in IT, we are actually underweight the large caps, but overweight on the mid caps. The large caps, basically even a bull case, we are talking about a decent single digit kind of a growth, not really trailblazing kind of growth, but there are niche mid caps which are doing much better and will structurally do better because of management changes, the niche segments that they work on. So IT mid caps is a good area for stock picking. In pharma, again, we are quite overweight, significantly overweight, not as a top-down call, but just because of the fact that we have so many bottom-up picks in the sector.
Okay.
So we are almost 500 basis points overweight in pharmaceuticals in our portfolios, and that's purely on a bottom-up basis. We are overweight on all the things like CDMO, even generics, healthcare, including hospitals, diagnostics. So across the chain, we found good bottom-up stocks. So it's not a top-down really call, but a bottom-up call.
Yeah, even for that matter, defense that you spoke about, it would have to be bottom-up, isn't it? Because valuations have also run up for several PSU stocks.
Actually, you need to then take a top-down call, because a top-down call would be a call for 5 years or 10 years, irrespective of the fact that the order books get delayed by a quarter or two, etc.
Oh, so you're still very positive on
absolutely,
that?
Absolutely.
Okay.
Because we barely scratched the surface on exports. And while there is a clear visibility of indigenization of production for the next 5 to 7 years, so that's going to double the industry size in any case if that comes through. But exports is something that can triple or quadruple the industry size because the global defense spending is $2 to $3 trillion.
A question that we get asked often is that, can you go out and buy a Zomato and Swiggy? You believe in the opportunity, but the stocks have run up.
Absolutely.
So is this it is a long-term opportunity, but at these levels, would you recommend going out and buying?
So we are quite positive on the new age companies. We have a basket of stocks in the segment. And again, there the call is how big is the runway and whether it's a winner takes all.
But you must have gotten it at lower levels, right?
That's fine, but we're not looking at 100% returns. We are talking about a 5 to 10 year runway for some of these stocks. And the fact is that in these situations, once you have that basic, subscriber base in place, it becomes an entry barrier. So it becomes a duopoly or a 3-player market, which is what we are seeing in a lot of these segments.
Okay, so even at these levels, it's fine if you have a long-term
Absolutely,
time.
because once you have the subscriber base, you can go for adjacencies, you can introduce newer services as long as you have the basic data in place for the subscribers.
Finally, the other top-down buy has been power. Almost every aspect of power, from the Tata Powers of the world to all the transformers and,
renewables,
T&D and renewables. Which part of the power space do you like?
So we are not so much on the utility side. But
not the generators.
Not the generation, not the utilities. We are more on the EPC companies and the equipment manufacturing companies, both on the transmission space as well as on the distribution side, especially companies which are doing EPC and equipment for the renewable space.
You spoke about large NBFCs. We have a large NBFC, Shri Ram Finance, joining in. So what are your thoughts on this company in particular, and what are the questions that you would have for the management? Like, what would be the key themes for a company like Shri Ram Finance going into next year?
So obviously I can't comment on individual stocks, but probably one should ask the management about visibility of credit growth for the next year, because I think the funding crunch probably is anyway going to ease over the next few months because of the RBI's stance, and even the government is making some noises about
Slow down.
slow down, etc. So you should see funding crunch ease in any case. So then the only thing remains to see is the top line growth. Maybe
Credit
we
pickup.
can, yeah.
Okay. Thanks a lot, Mihir, for a bunch of ideas that you have given us on what we thought was a holiday strained day. Thank you for dropping in our studio, and have a brilliant 2025.
Wish you a very great 2025, and to your subscribers also. And
Thank
you so much.
Thank you very much.